On this week's Emily Now episode, I'll be talking about collateral for business loans. I'll be talking about business valuations and whether or not you need one when you get a loan. We'll talk about a business and how they had to get some financing to expand. And I'll be talking about an article in the Globe and Mail about business owners not having an exit plan and how that can affect you. So stay tuned. My name's Dylan Gallagher, founder of emilynow.ca. I've been a finance guy for the past 18 years, helping people and businesses get the money that they need so that they can do more. We put together this Emily Now episode on a weekly basis, which is a series about finance with a particular focus on debt and as it relates to mortgages and loans. We do this because we hope that these episodes will teach you a little bit more about finance, about what's involved in finance, so that you can make better decisions, because we believe that if you can make better decisions, you'll probably end up saving yourself some money, and that'll help you in the future. It'll help you invest in new opportunities, and who knows, it might even benefit the community around you. And so if you want, you can follow us on Twitter. Emily Now Canada is where you'll find us. You can like us on Facebook, subscribe to us on YouTube, and send us a message. Send us your questions, send us your concerns. Let us know what you're thinking about, if it's a mortgage or a loan, and maybe it's something that we can talk about on an Emily episode in the future. But let's get started with this week's episode, which is mostly about business loans, and we're talking about collateral and exit plans and whether or not you need to have a guarantee. And so we've picked off a couple of questions that we saw come through. And the first question that we have today is, will I need to use collateral to secure my business loan? The short answer is yes. Many times you're going to have a percentage of the loan in collateral. So what does that mean? If you borrow $500,000 and you need a 20% coverage, or you need collateral for 20% of the loan, you're going to have real assets somewhere worth $100,000. Every bank treats this answer a little bit differently. Some banks, even though they lend off of cash flow for businesses, so what they do is they say, okay, can the business pay back this loan in the amount of time that we're going to give them? And we're going to give them 5 years or 7 years or some amount of time that this business will have to repay this loan. And so the cash is really the asset that they're using to secure their loan. But many times, one of the criteria will be how much equity is in the business. And the equity, of course, is the kind of the inherent value. And so the bank isn't going to just ask for you to make your payments every month on your business loan. They're going to ask for some security. They're going to say, we'd like a guarantee, we'd like a general security agreement, we want an assignment of proceeds. Oh, and by the way, the business owners, we'd like to maybe put a mortgage on their house, or maybe we would like them to pledge some additional security if we're not comfortable that the business is going to be able, or that we're concerned maybe that the business may not be able to repay the loan. So are you going to need collateral to secure your business loan? Many times the answer is yes. And one of the things that you can negotiate with the bank when you're talking to them about getting a loan is the extent to which the collateral is required. So if you're going to borrow $500,000, you may not need $500,000 worth of collateral. If you're going to borrow $500,000, maybe you only need $100,000 or $50,000 or $250,000 worth of collateral. But that's something that you can negotiate. The bank will ask for it, but it's something that you'll be able to talk to them about and interact with them. I'll just make a little note here about something called non-recourse financing, because I've mentioned the term personal guarantee. Many business owners fret about that, and they say, oh, I don't want to provide my personal guarantee. I mean, I've run this business for 10 or 20 or however many years, and I think it can stand on its own 2 feet, and so I don't want to guarantee the loan. That's referred to as non-recourse financing, where the bank or lender will have no recourse against you as the business owner. And many banks don't get very excited about that. Non-recourse financing is available, but it's very, very difficult to get, especially since the financial meltdown of a few years ago. you're going to have to provide a personal guarantee to some level. So again, if you were borrowing $500,000 and the bank says, look, we want a 50% personal guarantee, that would mean they want you to personally guarantee $250,000 so that in the event that the business is not able to pay the loan, that they can come after you for $250,000 worth of that loan. The second question that we have today is a business valuation required when getting a business loan? And the answer is generally no. When you're applying for a loan for your business, the bank is not going to ask you to get a valuation of what your business is. Again, remember, banks lend to businesses primarily on a cash flow basis. So what they want to see is that your business has enough cash that if they were to give you $500,000 and 5 years to repay them, that you could give them $100,000 a year plus interest. That's what they're interested in. A business valuation will become more important when you go to sell your business and you're looking for financing. But at the stage where you're applying for the loan, the valuation is not something that the bank is going to ask you to go out and do. And business owners tend not to really like that answer because in their minds, businesses will say, well, my business is worth a couple $1,000,000. So if it's worth a couple $1,000,000, I should be able to borrow $500,000, no problem. There's a couple things wrong with that. Just because you think it's worth a couple $1,000,000 doesn't mean that it is worth a couple $1,000,000. In fact, business valuations of private businesses can be very, very difficult to do because there's just so many different variables that come into play. So what the bank says is they say, look, instead of trying to get our head around what your business is worth, it's not that we don't care about it, but kind of in the way that we work out our math, we discover what we think your business is worth anyway. But at the end of the day, the reason we're lending you the money is because we believe that the business is of a certain quality and it has a certain performance history to it that tells us if going into the future, if we're looking for this business to repay us, that we're comfortable that they can do that. So business valuations are derivatives of net income, assets, goodwill, etc. They can be very difficult to determine, but banks are going to be looking for cash flow. They say cash is king, and businesses who have the cash can demonstrate historically they've had the cash, stand a better chance of being able to borrow money that they need for the future, and that's what banks are really after. So are you going to need a business valuation when you get a loan? The answer is no, you're not. And if you want to know what a business loan is going to look like, we'd encourage you to visit emilynow.ca. You can punch in the amount that you need. You can see the amount of income that you're going to have, as well as some of the other criteria that has to be met. And then based on how you score, you can see which banks in the marketplace would be prepared to accept your request, and then you can send it over to them. So we'd encourage you to visit emilynow.ca if you are looking for a business loan. We're going to move right along now into an example of a business that had to expand and some of the challenges that they faced when doing that. We've spent this Emily episode talking a little bit about collateral security and guarantees and business valuations. And so here's an example of what I've typically seen with the kind of client that we tend to work with, which is a client who's looking to borrow less than $10 million. That tends to be what we focus on every day through emilynow.ca. And in this particular case, this business had opened up a location. They were now looking to open a second location based on the strength of the first location, but the ownership structure hadn't quite been figured out, so when they went to open their second location, they started a new company with some new owners, or rather some new shareholders, and a totally different ownership structure compared to the first location that they had. The financing that they got for the first location was a little bit messy in terms of who provided the guarantees and what the collateral security was versus the second location, which again had different guarantees and different owners and different security. So the corporate structures were very, they needed to be sorted out, as it were. And now the business is looking to open its third location, and it's having to wrestle with the decisions it made in its first two locations. And really that happened because this business didn't plan for it. They didn't have a plan to expand. They didn't have a plan for how much cash they were going to need. And what I've noticed is finance guys or bankers or anyone who's never run a business is it's very easy to say, have a plan, make sure you know where you're going. But the very nature of being a business owner or being an entrepreneur certainly is being able to fly by the seat of your pants a little bit. I mean, many times business owners won't sit down and do a cash flow projection and have a business plan and do a target market study. They don't do all of those things before they make the decision to have the business. A lot of times business owners will intuitively say, I think this is going to work, now let me go to work and really make this happen. And then they pick the pieces up as they go. And so with this particular business that we're familiar with, that we've helped significantly, they didn't have a plan. And now that they're opening their third location, the business is now not so entrepreneurial. It now has some layers of management. It now has some best practices that it follows. And so opening its third location is really the moment in time when this business is saying, okay, now let's take a look at our projections. Let's see how we can clean up our corporate structures. How can we really put this business to be in a position of strength so that as we open our fourth and fifth and sixth locations, that we don't have to be concerned that our house isn't in order. And so because of their lack of cohesiveness in their first two locations, they did have to borrow expensive financing. But as time goes on, we're going to be able to move them from private financing to a mid-market type solution all the way up back to a traditional bank, which will be happy to have their business at that time, but probably wouldn't today. Not because they couldn't qualify, but because there's just so much work to be done to clean up what they've done so far that a traditional bank will say, look, why don't you just come back to us when you've sorted all of this out? So if you're trying to grow your business and you find that some of the things I've just shared sound familiar to you, I would encourage you then to jump on emilynow.ca, put in a loan amount that you think your business needs or is looking for, and then as you go through the process, we've got an amazing customer service team that's going to be able to help you out and make sure that your request gets put together properly and that it gets over to the right bank who can ultimately approve you. And in the course of doing that, we're going to help you understand what needs to be cleaned up so that you can in fact get the best interest rates and terms that are available in the market. So if your business is expanding and you need cash, go to emilynow.ca and get started. Owning a business is lots of fun, and I know in my experience in the past 18 years, I've met dozens and dozens and dozens of business owners. And one of the famous lines I remember hearing, and then heard it echoed with other entrepreneurs, so said a little bit differently, was, it's really easy to start a business, it's really hard to get out of business. And many business owners, when they reach that age of retirement, whatever that means, business owners tend not to truly retire, but when they really want to pull back and maybe spend some more time with family, maybe they want to golf some more, maybe they want to spend more time in the community giving back, they tend to find they don't really have a plan for how they're going to pull themselves out of the business. And in one case in particular that I know of, this particular entrepreneur had 3 businesses and loved all the employees for these businesses, did very well financially, had a very comfortable life, but when the time came to move on, he didn't have an exit plan. He didn't know how to sell it back to his employees. He didn't know whether to sell it to his competitors, so he actually just ended up shutting all 3 of them down, which was sad because he had spent a lifetime building them. There was lots of value that was locked into these businesses that had he gotten the help that he needed, he probably could have found a strategic buyer who would have been able to probably give him more money for it. But there was an article that ran in the Globe and Mail. It was written by Jacqueline Lowen, and it talks about how small businesses usually lack an exit plan and that a business owner needs a plan for the company to be ready to monetize their business at any stage. And because they have the majority of their wealth tied up in their business, having a plan is key. And so in our experience, we don't get involved in selling businesses. That's not the market that we serve. But we do get involved in sourcing financing for the purchase or the sale of a business. And banks do provide financing. If you're looking to buy a business, looking to buy a competitor, looking to buy out your partner, or maybe you're looking to sell to your partner, or you're pulling a shotgun clause in your shareholder agreement, banks will provide financing. But guess what? They require a plan. They need to know how is the debt going to be repaid. How is the cash from the business going to be used to pay down the principal? Can it be done in the amount of time that they're going to give you to do it, 5 years, 7 years, 10 years, etc. And because we service the marketplace where businesses are looking for less than $10 million, when a transaction comes along, or a client rather comes along who has a transaction for the purchase of a business, typically we tell them, look, the bank will put up a third of the money needed. You will have to have in cash a third of the money needed, and then the business that you're acquiring will have to keep, the vendor or the owner of that business will have to keep a third in the deal, and then you can repay them over time. Because for private businesses in particular, the bank wants to see that everyone's interests are aligned, and so they'll ask the the existing business owner to keep money in the deal. They will provide some money, and then they want the new owners to put some money in as well. So it's important to know, first of all, how that works, where that money is going to come from, how that deal is going to be structured. And even though private businesses can be difficult to put a valuation on, as it were, it can be done, and there's lots of people out there that can provide you with some really, really great help. As far as we're concerned, as we read through this particular article, which we'll post on Twitter and Facebook so that you can take a look at it as well, there's some very good things to know. And as it relates to financing, make sure that you understand what's involved in the financing. What are the payments going to be? What are the obligations going to be for you, the guarantor, the borrower? And how is the bank going to help facilitate a transaction for you? And so if you're trying to figure out where to start with all of that, we would encourage you to visit emilynow.ca, where you can put in the loan amount that you think you're looking for, or if you're looking to acquire a business or buy out a partner, the amount of money you think you need, and then go through the tool, and it's going to show you the income that's going to be required, and it's going to show you the documents that you need. But more importantly, you'll have access to our customer service team, who's going to be more than happy to help guide you the rest of the way, and not only guide you through some of the answers, but actually bring you right to the doorstep of the bank that would probably be best suited for the transaction. So thank you for joining us on this Emily Now episode. We look forward to seeing you next time, when we're going to continue to talk about mortgages, loans, finance, all in the hopes that we're helping you do more.